Hey guys, this is Mrs. Schoenberg. I have Chapter 8 notes up here. You'll notice it says Chapter 8 and Chapter 10. We are not going to be doing Chapter 10. We have cut that out of this semester. So I'm only going to be showing you the Chapter 8 notes. And also remember, there's all kinds of videos and resources in Canvas underneath Module 8, Chapter 8. Please take a look at all of that. Anyway, Chapter 8 is all about receivables. Okay, so we're going to talk about the different kinds of receivables, how to account when you cannot collect a receivable. There's two different methods. There's the direct write-off method and the allowance method. We're going to compare those two methods, and then we're also going to talk briefly about accounting for notes receivable. So first of all, accounts receivable are normally expected to be collected within a relatively short period of time, such as 30 or 60 days. 30 or 60 days. Notes receivable are amounts that customers owe for which a formal written instrument of credit has been issued. So we'll start talking about notes receivable here at the end of the lecture. Other receivables expected to be collected within 1 year are classified as current assets. If the collection you expect to be beyond 1 year, those are classified as non-current assets and reported under the caption investments. So sometimes companies sell their receivables to other companies. This is called factoring. Factoring the receivables, and the buyer of the receivables is called a factor. So that person, that company that might help you collect your receivables will actually buy those receivables from you, the business owner, and then go and collect the money. And so they would perhaps work on your behalf. Perhaps they paid you the money up front for the receivables. Perhaps they collect it and keep a percentage for themselves. Regardless of how careful a company is in granting credit, some credit sales will be uncollectible. Okay, if it's not a cash sale and it's a receivable sale, some you're just not going to be able to collect. So there is an expense associated with an uncollectible receivable. It's called bad debt expense. Sometimes you might see it as uncollectible accounts expense or doubtful accounts expense. So we're going to talk about two different methods on how to account for these uncollectibles. First off, the direct write-off method of accounting for uncollectible receivables records that bad debt expense only when the account's determined to be worthless. So the allowance method reports, and the allowance method, we'll talk about that one in a second, that reports bad debt expense up front. Okay, you're kind of estimating how much will be uncollectible, and we'll talk about that one in a minute. So direct write-off method, number one. On May 10th, a $4,200 AR from D.L. Ross has been determined to be uncollectible. So think of it this way. It's May 10th. It's a beautiful day. You're in your office. Your boss comes in and says, hey, I've talked to D.L. Ross several times now. We're just not going to be able to collect that $4,200 accounts receivable. Go ahead and write it off. Well, you're following the direct write-off method. So here's what that journal entry would look like. May 10th, you're going to debit bad debt expense for the full $4,200, and you're going to credit their AR balance, AR D.L. Ross, for $4,200. It's like they never owed it to you, if you will, because you're hitting bad debt expense and you're writing off their accounts receivable. So time passes. It's November 21st. D.L. Ross has been able to go ahead and pay that back. Okay, well, you've already written it off. So on November 21st, we're going to reestablish the receivable. Then we're going to apply the payment. There's two journal entries involved. So November 21st, we're basically going to reverse this entry right here. So we're going to reestablish the AR from D.L. Ross for $4,200. We're going to credit bad debt expense. So we have basically, what this is called is reinstate the AR. reinstate the receivable. Now, also on November 21st, we did get money in. They paid. So we're going to apply that cash of $4,200, debiting cash, and clearing out their AR once and for all. Okay. So this part is called basically applying the payment. Apply the payment that you received. That is the direct write-off method. It doesn't happen until you decide that it's worthless. Once it is, you debit your bad debt expense and you credit the AR. If by some chance they pay the money back, then you'll follow that process. Okay, the allowance method, it's a little bit more complicated. And of course, this one is the one that's GAAP approved. But under the allowance method, an adjusting entry is made for uncollectible accounts. When the account's determined to be uncollectible, it's written off against the allowance account. The allowance account normally has a credit balance after the adjusting entry has been posted, and it is a contra asset account. Okay, so what does that mean? On the balance sheet, you know how we've had accounts receivable, and it should have a debit balance, right? Well, right after accounts receivable, we're going to have this new account called allowance for doubtful accounts. Okay, I'm going to abbreviate over here, but this is our allowance account. Okay, allowance account. It's going to sit there with a credit balance. It's contra asset, meaning it works against. And so once we estimate how much do we think will be uncollectible accounts for the year, there's a formula you'll follow to determine that. And then you'll set this money aside in the allowance for doubtful accounts. And looks like that. Okay, so here's an example of the allowance method, a journal entry. On December 31st, X-Tone Company, this is the one where you have to estimate how much is going to be uncollectible and set it aside. So they're saying that $30,000 of their 200 AR balance is going to be eventually uncollectible. So the journal entry that they make at the end of the year in preparation for the next year looks like this, December 31st. Right off the bat, even though the uncollectibles haven't happened yet, they're going to go ahead and hit bad debt expense for the $30,000, and they're going to credit that new account, allowance for doubtful accounts, for $30,000. So they're setting aside this money. They're already taking the hit right up front. So time continues on for this company, and on January 21st, John Parker's account of $6,000 is written off because it's uncollectible. Now watch what this entry does. In the direct method, we immediately hit bad debt expense. Under the allowance method, we've already hit bad debt expense. So when we actually determine to write off account, here's what it's going to look like. January 21st, we're going to debit allowance for doubtful account. And that was $6,000. And we're going to credit AR for John Parker. Okay. So notice that the credit entry is the same for both. Okay. So under the direct method, we would have hit bad debt expense here and credited the AR. And under the allowance method, we go ahead and hit the allowance for doubtful account and credit the AR. Okay, Nancy Smith's account, $5,000. It was written off on April 2nd, kind of like what we did here with John Parker. Well, time passes, June 10th, they collect the money. So again, 2 entries are needed, one to reinstate Nancy Smith's AR and a second to record the receipt of cash. Okay, so June 10th, we would reinstate. It would look just like what we did here with John Parker. So imagine that that was Nancy Smith. We're going to reverse that entry to reinstate. So we have AR Nancy Smith, and her amount was $5,000. And then we're going to hit allowance for doubtful account to reverse that out. Then we're going to record the payment on June 10th. We got cash in of $5,000, and then we're going to go ahead and credit AR Nancy Smith to clear out her receivable for good. Okay, so those are the 2 methods. One question you might be thinking is, how do you determine how much is going to be uncollectible? If you're following the allowance method, at the end of the year, you have to determine, well, gosh, how much is going to be uncollectible for this next year? So there's generally 2 ways to do that. It's the percent of sales method or the analysis of receivables method. So in the percent of sales method, sometimes this is an industry standard. It's published. You kind of know if you're in a certain industry how much is estimated to be uncollectible. Okay, so if Xtone's company credit sales for the period are $3 million and it's estimated that 3/4% will be uncollectible, bad debt expense is debited $22,500. And I'm going to go over this math here in a minute. But here's what they would do at the end of the year, basically. They would, December 31st, they would go ahead and hit their bad debt expense because they're following the allowance method for the $22,500. And remember that credit goes to allowance for doubtful accounts, which is the contra asset account. Okay, now I do want to do just a little bit of a review here. Okay, if we said 3/4%, okay, if I converted 3/4 to a decimal, that would be 0.75%. And if I was going to convert this and drop my percentage sign, I would move that decimal point over 2 spots. And in the empty loops, I would put zeros, 0.0075. Okay, that's how they came up with this 0.0075. I just wanted to review that so you kind of knew where that was coming from. Okay, the analysis of receivables method, the longer an account receivable is outstanding, the least likely it is that you're going to collect it. So the longer you have this amount that people said they're going to pay you, the longer it goes on, the least likely it will be collected. So you kind of have this aging report, and that's how you estimate the uncollectible accounts. And that would be this one right here. So here are the primary differences between the direct write-off and the allowance. Okay, this is the one we talked about first and the second. So bad debt expense is recorded under the direct write-off when the customer accounts are determined to be uncollectible. Under the allowance method, you use an estimate. You do it at the end of the year. You set it aside. You either do that percent of sales or the analysis of receivables. So underneath the direct write-off, there is no allowance account. Underneath the allowance method is when you set aside and put that money in the allowance account. The primary users of the direct write-off method, small companies, perhaps companies with very few receivables, and then large companies and those with a large amount of receivables. And this one is the one that GAAP approves, generally accepted accounting principles. They recommend you doing that one. Switching gears here, we're going to talk about notes receivable. This is the second big topic of this chapter. A note receivable. Okay, basically this is a promissory note. It's a written document containing a promise to pay. So what's happened here is someone owes you accounts receivable. They cannot pay it. So you enter into a new agreement with them, and instead of it being an account receivable, you convert it to a note receivable. So not only do they owe you the money, but they also owe you that money with interest, okay? And this is an example taken out of the book of kind of what that might look like. But the maturity value is the amount that must be paid at the due date of the note. That maturity value is the sum. So you're going to add the face amount and the interest owed to get maturity value. Okay, so let's do a little review over here. Let's do calculator review. So face value. Let's say you set up a note that is $5,000. It's a 90-day note with interest of 10%. Okay, what's the math to figure out the interest? Well, looky here. If I take 5,000 and I'm going to take that times 0.10, and I'm going to take that times 90 divided by 360, that is going to equal $125. Okay, now let's review. The $5,000 came from the face value. Notice on the 0.10, I did have to convert that percentage to a decimal. And then I took it times 90 divided by 360. So I had to do it 90 over 360 because this 10% is an annual rate. And since the note was only for 90 days, I had to take 90 divided by 360. Now, I will say this. You can put this straight into your calculator. You could say 5,000 times 0.10 times 90 divided by 360 and check it. You'll get $125. So that represents the interest. So what is the maturity value? The maturity value is going to be 5,000 plus 125, which is 5,125. Okay. Let's do one more of these just for practice. Let's say we had a 6,000 face value. The interest this time is 12%, and it's a 30-day note. Okay. So my calculator, I do 6,000 times 0.12 times 30 divided by 360, you'll get interest of $60. So your maturity value is $60,000 and $6,060. Okay, so let's go back over here to some of these other calculations. Here's where I left off. What is the due date of a 90-day note dated March 16th? The book, you can look at to see how the book does this. But some months have more than 30 days, and there's one month that has less. So it becomes a little tricky. In my mind, March 16th, I'll go out, that's basically 3 months. I'll go out 3 months, so March 16th, April 16th, May 16th, June 16th. Then I'll think to myself, did any of those months, March, April, or May, have 30 days, or more than 30 days? So March had 31 days, so I need to subtract 1 day. April only had 30 days, so that works. May had 31 days, so I have to subtract another one. So what that means is it's not really June 16th, it's June 14th. Okay, and read the chapter on this. They have a different way of doing it that might make more sense. But anyway, here's how we're going to account for notes receivable. So we received a 6,000 12% 30-day note dated November 21st in settlement of W.A. Bunn Company. Now, I've already done the math on this over here. So let's go ahead and do the journal entry. So it's November 21st. And what we're going to do is we're going to debit notes receivable for 6,000, and we're going to credit AR W.A. Bunn Company for 6,000. So notice here, on the very first day, we just simply have converted it. We have debited notes receivable to set up a new notes receivable in the amount of 6,000. We have credited the AR W.A. Bunn account. So we have converted their receivable, accounts receivable, to a notes receivable. No time has passed, so no interest has accrued on this. Okay. Now, it was only a 30-day note. It's now December 21st. It's time for W.A. Bunn to pay up. Sure enough, they pay $6,060, okay, and we've calculated that, so they paid the correct amount. $6,000 was the face amount, $60 was the interest. It's December 21st. Here's how we're going to record that. They actually did pay a full cash amount of $6,060. We're going to credit the notes receivable for the amount of $6,000, the face amount, and then we're going to credit interest revenue for $60. Okay. If pretend that didn't happen, that's what this next example is. Let's say they didn't pay the note on the due date. It's considered a dishonored note. The note and interest are transferred back to the customer's accounts receivable. So let's say instead W.A. Bunn doesn't come through on December 21st. Look at this entry. We're going to put it back into their AR, W.A. Bunn. This time it's not 6,000, it's the 6,060 because of that formal written agreement that they agreed to pay us interest. We're still going to go ahead and debit interest revenue for 60. We're going to recognize that. And we're going to credit, we're going to take this back out of the notes receivable. Notes receivable for 6,000. Okay, so this was supposed to be a credit as well. So the debit is AR Bunn for 6,060. The credit is interest revenue for 60 and notes receivable for 6,000. One more to go and we are done. Vista Supply Company, they received a 30-day 4% note for $90,000 dated September 8th. We're going to determine the due date of the note, okay? Then the maturity value of the note. Then we'll just journalize the entry to record the receipt of the payment of the note at maturity. Okay, well, 30 days from September 8th, just go up to October 8th and then ask yourself, did September have 31 days or 30 days? Well, it only had 30 days, so that's the correct answer. The maturity value of the note. Okay, in your calculator, you're going to want to do 90,000 times 0.04 times 30 divided by 360, and that's going to get you the interest, right? The interest here is 300. So the maturity value is 90,300. That is your maturity value. So when we journalize the entry to record the receipt of the payment, what we have received from them is 90,300. So cash received is 90,300. Interest revenue is 300. And then we would credit out the notes receivable face amount, 90,000, okay? So that is your Chapter 8 notes. I hope that helps. Again, Chapter 10, we are not going to be tested over that. We're not doing any homework over that. We are going to be skipping that chapter.